Hi, Eva.
Hello.
Hi. Hello. Just checking on the people we have from EABC.
Yes, this is Patrick. I'll be supporting on the technical aspect.
Okay. Thanks, Patrick.
Okay.
So Johnson, you can try to unmute and do a bit of presentation, or is it going to be Koshuma?
Yes, hi, Frank. So I'm seated here with Rafael Koshuma. Yes, so we're just setting up, and then we can just quickly do a dry run on the presentation. Okay.
Alwa Moniche, maybe stop projecting. We allow Rafael Consumer to project. Yeah.
Okay, okay. Okay, Mr. Moshi.
Okay, so Frank, I think it works on our end. We should be ready to do the presentation. I understand you are starting the first part, so maybe we'll just stop the testing and then it over for you so that you can be ready for the first part. And then when you're done, we'll come in and do the presentation on our end. Thank you.
That's fine. So you are satisfied with the current appearance, and if you are able to use all the functions?
Yes, we are satisfied. I hope you can see our slides on your end as well.
Yeah, just the cover page.
Yeah. We should be able to present and continue when time comes. So it is fine.
Sounds. So in case of any of your team members who join, you can just ask them to raise their hands, and then we'll give them presenter mode. Hello, good afternoon, everyone.
Good
My
afternoon.
name is Frank Daffer from the East African Business Council. Yes, yes. So, as you are part of this webinar today, I just wanted to welcome each and every one of you who has joined so far. And we are still organizing some of our keynote speakers. So, I'm kindly request that you bear with us. We are going to begin shortly in the next 10 minutes. So, in the meantime, you can just can use the chat box just to introduce yourself and your company, where you are and where you represent, so that we can also know each other. So again, I just ask each and every one of you to give us a bit of time, and we are going to begin shortly. Apologies, everyone. I had a bit of a technical challenge on my end, but I hope you can hear me now. So I was just requesting each and every one of you to kindly give us a bit of time. We are going to begin shortly. We're just finalizing a few of the speakers, and we will begin. So kindly use the chat box to introduce yourself and your organization for the meantime. But we are also projecting some of the ground rules for our webinar today. So kindly uh, read them and observe them for the purpose of our meeting today. Good afternoon once again. So I would like to warmly welcome you, each and everyone, for joining and for making the time. So today we are going to have our webinar on the pre-budget for some of the East Africa Community member states. And kindly, I would request you to please observe the rules that we have projected on the screen. Mute your microphones, and in case you want to contribute, you can kindly use the chat room, or you can raise your hands, and we are going to give you an opportunity to speak. So my colleague is going to show the program of the day. Monique, if you can scroll to the program. So we are going to have some welcoming and introductory remarks from our acting executive director, Mr. Adrian Jau. But further, we're going to have opening remarks from our vice chairperson, Mr. Simon Kaheru. And fortunately, we could not get the confirmation from EAC because they have other engagements in this time of the day. So we will only have remarks from Mr. Kaheru. But after that, immediately we are going to jump into the presentation on the ongoing excise duty harmonization in East Africa, which is going to be done by me. And after those presentations, please scroll next. So after the presentations, we are going to go straight into the harmonization process and the different national budget presentations at EAC, which are going to be done by PwC. And later on, we're going to open the floor for question and answers, and we will have the closing remarks at the end. So again, to start off our program today, let me take the opportunity to welcome our acting executive director, Mr. Adrian Jau, for his brief introductory remarks.
Thank you very much, Frank. I'm going to be very brief because I understand my chair of the Policy and Advocacy Committee and the vice chair from Uganda is the one actually who is going to make elaborate remarks and open remarks. Let me take this opportunity to invite you all to this important pre-budget webinar on tax proposal for the fiscal year 2025-2026 for the EAC partner state, which actually have harmonized their fiscal year. Here we are talking of United Republic of Tanzania, Kenya, Uganda, and Rwanda. We are very grateful to PwC for actually collaborating with the EABC in terms of organizing this webinar. We have been doing this for a number of years, and we don't take it for granted. And we are very, very much grateful to PwC team for collaborating with the EABC. My argument is actually to urge the private sector across the EAC partner state to make sure that they usually participate in the pre-budget national consultation in order to influence the tax proposal, which actually they are supposed to improve or create conducive environment for doing business, but also make sure that those tax proposals, they are not in conflict with EAC commitment, especially the Treaty for Establishment of the East Africa Community, as well as the other annexes, such as the Protocol on Customs Union and Common Market, as well as Monetary Union. But also, I'm urging the policymaker to make sure that the pre-budget consultation cycle actually they are supposed to be harmonized across the EAC partner state. This will give us an opportunity for all EAC partner states to influence the regional pre-budget consultation. Another important proposal is actually to advocate for all EAC partner states to harmonize their fiscal or financial year to start in 1st July and ended in 30th June. This will be very important because most of the time you find that during this time around, a partner state come up with a tax proposal which actually influence business decision for the private sector. Lastly, and which also I think it is very important, you will understand that already the EAC have identified fiscal and tax policy misalignment is one of the challenge which actually impacting or frustrating intra-EAC trade and investment. So for these few remarks, I take this opportunity to welcome you all, but also to invite our Vice Chair from Kenya, from Uganda, and the Chair of the Policy and Advocacy Committee to make his remarks. Welcome, Mr. Simon Kahero. Karibu sana.
Asante sana, Adrian. Edie, thank you for those scene-setting remarks, and thank you for organizing today's webinar so efficiently. Allow me to kick off with our acknowledgements. First of all, we acknowledge the physical absence of the East African community, but we are happy that Deputy Secretary General, Madam Annette Semwanga, considered attending, as she is a very keen supporter of all private sector activities. So we know she is here in spirit, and the EAC is well represented in one form or another. Our EABC board members present today, members of the East African Business Council and private sector representatives from all our partner states, the East African Business Council Chief Executive Officer and your team, our colleagues from PwC, and panelists today, ladies and gentlemen, good afternoon. On behalf of the East African Business Council Board, I thank you all for dedicating time to participate in this important webinar. It's a pre-budget webinar on proposed taxes and fiscal measures for 2025-2026. And in the same spirit, I'm privileged to deliver this afternoon the appreciation of the private sector across the whole of East Africa to PwC for partnering with the East African Business Council to organize this important discussion as we prepare to receive from our governments their national budgets in a couple of weeks' time. First of all, we should all be proud that we have collaborated annually between the East African Business Council and PwC to make this pre-budget webinar a calendar event. And we need to give these two organizations a round of applause, either through technology or where you are. Because to maintain this consistency year on year, ahead of the governments themselves reading their national budgets, is extremely important in helping our private sector understand what the new tax proposals mean across the region, not just in the individual partner states, but also to advise all the members of the private sector on what business decisions to make for the good of their businesses and economic growth across the region. And ladies and gentlemen, this is why we are here, for economic growth across the region, but economic growth that is driven by private sector activity. And we trust that even as we discuss here as members of the private sector, our partners in economic development, the public sector, the governments, are also going to benefit from these discussions because they will get to hear from us, the people, the organizations that drive the economies, what they need to do when setting policy. And they get to understand that they're doing it not for the good of business alone, but for the good of the people of East Africa. As you're all aware, these budgets, the national budgets are going to be read in 2 weeks, and this has become customary as per the pre-budget consultations of the finance ministers across the region. And as per the agreement within the EAC treaty that all these partner states signed, the expectations of the private sector across East Africa and across the community are that these new tax measures that are going to be introduced will consider all the recommendations that we put before our governments in the build-up to the day of the budget reading. And our recommendations, our suggestions that we presented to the governments were aimed at building the national economy, but with a view to building the regional economy. And I must applaud the different members of the private sector in all the partner states that ensured that even while considering the national interest in setting fiscal policy, we reminded the governments at all points to look at the regional economy. This was regardless of all the different negative impacts that we have seen coming our way as East Africans, and that the rest of the world has seen, whether it's trade policy shifts with partners such as the US, the ending of the Africa Growth and Opportunity Act, and many other different moves that have affected us. We've stayed true to the course and said we need to focus on growth of business within East Africa. Thinking positively, the new tax measures should make the business environment in our community, our East African community, more conducive for a private sector activity to thrive. And at this point, we must reflect that today we're in a very different position from where we were 15 years ago. The feeling that we would have at this time, as we head into budget reading days, was more or less ominous. We went into this day with a sense of gloom, a sense of worry. But today it's different because we know we have had engagements with the government and we are more or less sure about what they are going to say and why they are going to come out with these proposals. Ladies and gentlemen, that is proof that the aspirations of the East African community are being met in some great measure, and we should not take it for granted. The discussion that we're going to have this afternoon on its own also needs more applause because this webinar is going to focus on these domestic tax proposals that are looking at the different heads like excise duty, income tax, value-added tax, but we're going to look at them considering the disparity of the different tax regimes within the partner states, but to bring them all together with an East African eye. Under the East African community integration, partner states have still retained their mandate for domestic taxes because it is understandable. The sovereignty of each partner state is important. There are different national aspirations, but the purpose of trying to bring it all under this one East African umbrella is to create that harmonization that will make the East African Common Market and East African Customs Union a reality, and a reality that builds, that grows business activity within this region and makes us more competitive, both as a single investment destination, a common market, and also as an engine for further growth into the rest of Africa, because we have a big market to command. And all East Africans here are aware that that market can be ours for the taking if we focus our public sector to doing the right things that will encourage the private sector to activate the engine into the places that we know we need to be. Ladies and gentlemen, the freedom of developing and managing domestic taxes, it has embedded these disparities to some level within the different partner states. We see unfair competition in some places. We see unequal treatment of taxpayers in other places. But overall, not all hope is lost. We know that the governments are aware that intra-EAC trade and investment is hampered when the wrong things are done or when the right things are not done. And we know that this gives us a continuing opportunity to engage as the private sector, the ones who are actually doing business, in order to bring these aspirations back on course. And we do so through the different bodies of the East African community, who then guide the national governments to remember that they have a duty to make this aspiration a reality. The East African Customs Union Protocol is going to unlock, if it is taken as seriously as we believed it would be 25 years ago, more than 25 years ago, is going to unlock the rest of Africa and therefore the rest of the globe for all the business activities that East Africans want to do. And that is why, ladies and gentlemen, we invite you at every turn and opportunity to join the East African Business Council in urging these partner states to fast track the harmonization of domestic taxes within each state, but also to eliminate all discriminatory fiscal practices, because these do not align with the principles of the customs union or the common market protocols, and certainly do not help us as East Africa take the rightful position that we should have on this continent of Africa and in the world. We should all make it clear that the beneficiaries will not be the private sector alone, but the public sector that feeds off our taxes to meet the socioeconomic needs of all East Africans. And I'm happy that the team that we've put together this afternoon to lead these discussions and to guide them is a team composed of, I think, our topmost experts across the region from PwC, who are going to delve into the insights of these proposed tax measures and allow us, as members of the private sector, to critically evaluate how these measures will impact our businesses, but also the economies in general. And I once again urge you, all attendants here today and all members of the private sector, to remain united and keep pushing these partner states to harmonize domestic taxes so that we encourage the movement of goods and services across this region, optimal allocation of resources, and therefore take up the rightful spot when we move into the Africa Free Continental Trade Area and beyond. Mabina Mabwana, I urge participants to take this opportunity to share all knowledge you have of our competent tax experts here today from PwC. I trust that this webinar is going to be successful. I urge you again to continue with the advocacy for harmonization to make this region a single investment destination, one common market with one people achieving prosperity and development together, pamoja. With these few remarks, I declare our webinar officially open. Nashukuru sana.
Thank you very much, Mr. Kaheru, for those wonderful remarks. So right away, we are going to start with the presentations. So the first presentation of the day will be done by me on the process of harmonization of domestic taxes. So I'll be sharing a brief presentation. I hope you can all see my screen. Okay, so let me just put it in presentation mode. So our presentation will focus on 4 key points. The first one is the EAC policy for harmonization of domestic taxes. And we're also going to see the progress of harmonization of excise duties on some of the key products that were considered by the partner states, especially the committee, the fiscal committee affairs. But also we are going to discuss the divergences and the conclusion and recommendations. So in general, the EAC policy for domestic tax harmonization was tabled by the Council of Ministers and approved in 2019. And the policy main focuses, or it provides the context for rationalization of tax harmonization in the EAC region, but also it provides the key objectives for harmonizing the different domestic taxes. Some of them noted excise duty, VAT, and income tax, but it also provides some of the guiding principles, such as the sufficiently flexible approach, which has to be used by partner states when they are doing the harmonization. Mainly, it emphasizes that partner states need to agree on a minimum rate for harmonizing the domestic taxes, but also the process should be gradual among the partner states. So I think the key part of the policy also is that it calls for partner states to maintain and coordinate a mandatory list of dutiable goods and services, optimal rates, base of excise duty, but also the regime for excise duty, notably the ad valorem, specific, and hybrid. So when it comes to the progress of harmonization of excise duty, currently there was an engagement since 2024 at the EAC level, whereby the tax administration subcommittee requested the support of IMF to do a study and to propose the minimum excise duty rates for alcohol, tobacco, non-alcoholic beverages, and fossil fuel. So IMF did that analysis based on the data that was given, and submitted the recommended minimum rates for excise duty rates to the subcommittee.
Then the subcommittee did consultations and submitted those consultations to the Fiscal Affairs Committee. So in the next presentations, we are going to see how those consultations went on the different products. So starting with the excise duty on alcoholic products. So the committee had agreed to the minimum rate for harmonizing alcoholic products should be based on USD per liter of 100% alcoholic content. But also some of the key principles set for this harmonization should base on that the rate would require differentiating would not require differentiating the different beverages, but also they should not be affected by VAT in the region, and other neutrality principles should be observed so that the alcoholic beverage sector is not impacted, but also the rate should be simple and predictable for the entire sector. All of these are also in alignment with the international principles and the EAC treaty as stipulated in Article 83, but also the Customs Union Protocol, Article 15 on national treatment and other WTO rules. So when it comes to alcohol, the range for the minimum excise duty rate was proposed to be between $6 to $10 per liter of 100% alcohol. So following the different consultations by the committee, the tax policy and tax administration subcommittee, they had divergent views. As we know, partner states have different interests when it comes to charging excise duty. So the Republic of Kenya and Uganda actually preferred to have a rate of USD 8 per liter of 100% alcohol, while Burundi, Rwanda, South Sudan, and United Republic of Tanzania proposed to adopt a rate of $6 per liter of 100% alcohol. DRC Congo also participated in the process, but they sought for more consultation on this area, so their opinion was not yet tabled by them. So when the committee submitted their divergent views to the Fiscal Affairs Committee, the committee also considered the proposals, and the committee proposed the range for the minimum rate of $6 per liter of 100% alcohol content to be the one to be applied by partner states in EAC. So based on this rate, the different products that were considered in that category will be beer. So beer will be charged at a rate of $0.3 per liter. Wine will be at 0.72 per liter, and spirit will be at 2.4 per liter. Again, there was discussions on the minimum excise duty rate for tobacco and other nicotine products. So it was agreed that the minimum rate for harmonizing the excise duty rate for nicotine products should be based on kilograms of tobacco, USD per kilograms of tobacco, and the rate should apply on risk-based taxation, mainly focusing on the impact of smoking and other challenges related to nicotine products use, but also the risks should not be affected by the different VAT, but also they should support neutrality, allow simplicity and predictability, just the same as the one we saw in alcoholic beverages. So the proposed rate for the range for the tobacco products to be charged, the minimum rate of excise duty was between 0.4 and 0.8 per kilogram of tobacco. So that was the rate that was based in the discussion, and according to the IMF, I believe there's a mic that is open. Maybe my colleagues can help me to mute the mic that is open.
Right off the bat. And
So
over the course of the summer, we actually became really good friends. I would even try to introduce him to my friends, my girlfriends, saying, there's this really cute guy who's my advisor, because
yeah, sorry for that. So again, according to the rate of tobacco and other nicotine products, it was proposed that the range should be, IMF considered the range of 0.6 per gram of tobacco as the one that should be recommended and applied by partner states. So if you break down that rate on different products of cigarette and tobacco, it would apply on the range of, for example, for cigarettes, it would be charged at 0.048 per stick or 0.96 per pack. For loose tobacco, it would be $60 per kilogram. Electronic and nicotine delivery system, it would be at $0.048 per mil. Heated tobacco or in stick form, it would be at 0.0096 per stick. And heated tobacco in loose form, it would be at $0.018 per gram. So following the consultation by partner states under the Tax Policy and Tax Administration Subcommittee, they had divergent views. And for Kenya and Uganda, they preferred to adopt the rate of USD 0.06 per gram of tobacco, while Burundi, Rwanda, South Sudan proposed a different rate of which is lower at 0.04 per gram of tobacco. But on the other hand, the Democratic Republic of Congo and United Republic of Tanzania wanted more time for consultation. So when these divergent views were taken to the Fiscal Affairs Committee, the Fiscal Affairs Committee also had divergent views, where Uganda again proposed to adopt a minimum rate of 0.06 per gram of tobacco, while Kenya, Burundi, Rwanda, South Sudan preferred the rate of 0.05 per gram. And then Tanzania came with a different rate of 0.014 per gram of tobacco. So from there, we can see actually later on in the conclusion that there was no agreed minimum rate for tobacco and other nicotine products. So if we move to the harmonization of excise duty on non-alcoholic beverages, here the main principle for harmonization was agreed that the minimum rate should be based on the amount of USD per gram of added sugar. So the rate again will not be affected by the factors that we said earlier, issues of VAT, but also it should be neutral and simple and predictable when it comes to these products. So the range for setting the minimum excise duty rate was between $0.08 and USD 0.012 per gram of added sugar. And the consultants or the expert at IMF, for them, they recommended that partner states should apply a rate of USD 0.001 per gram of added sugar. And this rate, when you translate it to different products, it will be that soda will be charged at 0.106 per liter. Fruit juices would be, if there's sugar added, it will be charged at $0.098 per liter. And if there's no sugar in the juice, then it will be zero. So following the discussions again, there was divergent views at the subcommittee level. Kenya, Uganda, Burundi, Rwanda, and South Sudan proposed the rate of USD 0.001 per gram of added sugar. Democratic Republic of Congo requested more time to consult, and even Tanzania wanted more time to make consultations. So the same views that were divergent when they were submitted to the Fiscal Affairs Committee, again, they were divergent views, but we can see at least most of the partner states wanted to converge at the minimum rate of 0.01 per gram of added sugar, while Tanzania proposed to adopt a rate of 0.0043 per gram of added sugar. So the proposals for determining another product was fossil fuel. And this one, they wanted to set a rate that would consider other factors that are externalities of using fossil fuel products. So issues that would relate to global warming, accidents, local pollution, congestion, road damage were also factored in when the rates were proposed. So the ranges for the rates for the different products are as follows. So for gasoline, it was USD 0.29 to 0.41 per liter. For diesel, it was 0.26 to 0.82. For kerosene, it was 0.15 to 0.17 per liter of kerosene. And for coal, it was USD 173.71 to 245.97 per ton of coal. So IMF again consulted, and for them, they gave a recommendation that for these fossil fuel products, the rate should be, for example, for gasoline, $0.35 per liter. For diesel, it should be 0.38, kerosene 0.16, and for coal, 195.63. So again, we saw that from the discussions at the subcommittee level, there were divergent views. Kenya, Rwanda, and South Sudan preferred the rate of 0.29 for gasoline, $0.26 per liter for diesel, 0.15 per liter for kerosene, and USD 173.71 for coal. Uganda, for them, they said they wanted to adopt a rate that was proposed by IMF, which I had highlighted earlier. But for kerosene, they had a different opinion, which they wanted more time to consult. Burundi, on their part, they thought that the issue of petroleum and fossil fuel is a very pertinent issue, and it has a larger impact to the economy. So they thought a wider study needs to be conducted on how the different prices would affect the economies of the region. So they wanted a study to be conducted by EAC. But also DRC wanted more time to consult. Tanzania had a very different opinion. For them, they thought that we don't produce some of these products, and therefore we do not need to have a harmonized discussion on how to charge excise duty on them. So based on those, again, the Fiscal Affairs Committee, again, they had other diverging views. For Republic of Uganda, Kenya, Rwanda, and South Sudan, again, they maintained the same position. And for Burundi, it preferred a different rate for gasoline at USD 0.12 per liter, and USD 0.11 per liter of diesel, and USD 0.08 for kerosene. Again, United Republic of Tanzania continue to maintain their position that they propose to remove fossil fuel from the list of mandatory excisable goods, citing that these products, some of them are not produced in the region and they are not traded that much across partner states. So in terms of conclusion, we could see that the Fiscal Affairs Committee made only one agreed recommendation, which pertains to alcoholic beverages, where they had agreed that they should be charged at USD 6 per liter of 100% content within the EAC. So this rate translates differently to beer, spirits, and wines, as it was demonstrated earlier. But we also saw that the committee had divergent views on the minimum excise duty rate for tobacco and other nicotine products, but also on alcoholic beverages and fossil fuel. So these products are yet to be, the rate for their minimum excise duty has yet to be decided, and more consultations are to be done at the national level and at the EAC level. So given the above, EABC would like to table a few recommendations. The first one is, first of all, to ensure there is adequate consultation with the private sector on the minimum excise duty rate for tobacco and other nicotine products, non-alcoholic beverages, and fossil fuel. We urge the partner states to ensure that they consult the private sector on these particular areas. But also we commend the EAC, first of all, for doing the work that they have done so far, and we urge them now to fast-track the process of harmonization of the domestic tax regime of the EAC region. So with those few points, I would like to submit my presentation. So again, I'll be the one to speak. Apologies, you will hear my voice a lot today. So without further ado, I think we can now go straight to the So in case you have any questions on the presentations that are made, I would ask you to put them in the comment section, but we'll have a Q&A session after the presentation from PwC. So let me now take the opportunity to welcome colleagues from PwC for their presentation.
Thank you, Frank, for the very excellent presentation, setting the tone of our session today. I'll just switch on my video for a few seconds for the introductory part. My name is Johnson John. I'm a senior manager in the PwC Tanzania tax team. Today with you here, we have presenters from 4 countries. We have presenters from Tanzania, Kenya, Uganda, and Rwanda. So we'll be presenting various tax proposals from those countries. Because there are a good number of us, I will let everyone introduce themselves as they are presenting their part. So on my end, I will start by taking you through the regional comparison to give you an overview of the tax landscapes in the region. Yeah, so just as an overview, in terms of the different tax rate, starting with the corporate income tax rate, the rate is fairly the same across the region at 30%, except for Rwanda, which has a slightly lower rate of 28%. Then in terms of payroll taxes, starting with the taxes on employer, what we have seen is the tax rates in Tanzania are on the higher side, where the rate is 14% as compared to 10% in Uganda and 8.3% in Rwanda, and the very nominal rates or taxes being payable in Kenya. The other thing that we have seen, which has been an outcry for taxpayers in Tanzania, is in terms of duplicity of the payroll taxes. As you see on the analysis there, the 14% that I've mentioned is made up of the social security contribution, the SDL, as well as the workers' compensation. And each of these comes with its own compliance requirement and increasing the compliance burden. Moving on to the employees, talking of the effective rate, which is a combination of the income tax marginal rate and the social security contribution. Uganda is on the higher side with the 14% effective rate, made up 40% corporate, 40% income tax or PAYE, as well as the 5% social contribution by the employee. And then next is Tanzania at 40%, and then you have Kenya and Rwanda at fairly the same rate of 35 and 36 respectively. In summary, in terms of the social security contribution, Tanzania is on the higher side. Again, when you combine the employer and employee portion of the contribution, the rate is at 20%, which is relatively higher compared to Uganda at 15 and Rwanda at 14. And then Kenya again, what we're seeing is a nominal rate. So generally, on the payroll taxes or employment taxes, Kenya seems to be faring very well with some effective rate of 35% and a very nominal contribution from the employees or social security. Moving on the withholding tax, so we have indicated a number of rates there. What you're seeing where there are double rates, the first one is the rates applicable where a supplier or the recipient of payment is a resident entity. And then the second one is where the recipient is an non-resident. Now, what you see is for non-resident, the rates generally range from 10 to 15%, depending on the nature of payments across all the countries, except for few outliers in instances of, say, rent for Kenya, where in some instances the rate could go as high as 30%, as well as on interest payments, where In Kenya, the rates could go as high as 25, and then in Uganda, the rates could also go as high as 20%. In terms of the applicable tax rate for payments to resident suppliers or resident recipient, relatively compared to payments to non-resident, these are relatively lower. And also, I've been seeing some variation, but most of the rates are around 5% for most of the payments, with a few exceptions. I think the key interesting point to note there is what is happening in Rwanda, where generally what the law provides is if the recipient of payment is tax compliant and they have the tax certificate to prove that and they've met some conditions, then there won't be an obligation for the payer to withhold tax. And we'll talk on that when we are going through some proposals coming through countries. I think this is one of the proposals I've been putting across in Tanzania. Moving on in terms of the VAT and the excise duty, VAT on local supplies is also mainly at 18%, except for Kenya, where the rate is 16%, and also for Tanzania, in Zanzibar, the rate is 15%. So for Tanzania, in mainland, we have 18%, and Zanzibar, we have 15%. For exports, these are zero-rated, so there is a consistency there across all jurisdictions. Then on excise duty, I think Frank has done a very detailed submission on this. The rates varies depending on products or the nature of services. But I mean, I will just quickly talk through telecoms and financial institutions, where what we are seeing is the electronic communication services in Tanzania, the excise duty rate for that is relatively higher at 17% as compared to the neighboring countries. Whereas when you go to the financial institution, it's a slightly different story. The rates for Tanzania is lower as compared to Kenya, where the excise duty is levied at 20%, and Uganda, where the excise duty is levied at 15%. Now, you can't just look at the taxes on their own without also considering the budget processes, which drive these tax changes that we're seeing on a yearly basis. So in terms of the budget process, the processes themselves are fairly the same across countries, setting aside Rwanda, where, I mean, towards the end of years, stakeholders will be invited to do submissions to the National Treasury, or I mean various task forces that are there, and there will be various engagements. But the key differences that we are seeing is in terms of the timings and the level of engagements in jurisdiction. Now, this you will see on that line on the finance bill, where in Kenya, the bill is generally issued in April. So stakeholders have around 2 months to read the bill, analyze it, engage with the parliament and the government authorities to effect the change. But also it gives companies a room to do any necessary changes to their IT systems as well as the internal processes to make sure that they are compliant when the Finance Act is issued. It's also the same in Uganda, where there is roughly a 3-month period for that whole process. Now, this is quite different in Tanzania, where the finance bill is issued mid-June. So this year, we're expecting the finance bill to be issued in 12th of June. So effectively, stakeholders have 2 weeks to react from when they first have a view, the initial view of the finance bill, but also to make any adjustment necessary to their systems to be able to be compliant with the rules that across all countries, I mean, across all these 3 countries, those Finance Act changes become effective on 1st July. Now, probably I'll take you through now the proposed measures for 2025-2026. I will cover the first part of the measures proposed in Tanzania, and then my colleagues will come to talk through the other part before we invite our colleagues from other jurisdiction. Now, in Tanzania, to begin with, so as I mentioned earlier on, our finance bill is yet to be issued. So different to other jurisdictions where they will be presenting what is actually the proposal that are actually in their finance bills. In Tanzania, we will take you through the changes that have been submitted to the task force and the parliamentary committees by various associations and business groups. So to begin with, in terms of the tax administration budget process, as I indicated earlier on, the outcry in Tanzania has been the sufficiency of time for engagement by the stakeholder. So the proposal that has been put across is to have the finance bill issued early on, at least 2 months or 3 months before the issues of Finance Act, to allow for those engagement. This is also to align that timing in the budget process is what we are seeing in Kenya and Uganda. The other proposal is on timeline for provision of information. So there is a law in the Tax Administration Act which requires for taxpayer to provide information within 14 days from the date such information is requested by the Revenue Authority. In most instances, that timeline does not tend to be enough. Depending on the nature of the information requested. In some instances, those information are not even locally available. It might be an information that has to be sourced from the group or maybe from other business partners. So the proposal here is for that timeline to be extended to say 30 days and also for there to be an automatic extension of say 15 days in case a taxpayer requests for an additional extension in case they can't find that they can source that information within time. The reason why this is an important one is also because the law also provides that if you don't provide the requested information within time, then the Revenue Authority are within their right to deny that information to be used at a later stage of dispute in case you go through a dispute resolution processes. The other proposal is on the tax deposit waiver request. So there is a requirement to do a 1/3 deposit in case a company objects to an assessment issued by the Revenue Authority. The outcry here is there is no clear set of conditions in terms of what are the conditions or situations that warranties for a taxpayer to be given a waiver. So it's purely at the discretion of the commissioner or at the discretion of the Revenue Authority. And then in case that decision does not go in favor of the taxpayer or the request is not granted, then there is no recourse or channels for the taxpayer to appeal or challenge that decision. So this puts the taxpayer at a risk of missing their right to object to the tax decision issued by the Revenue Authority. There's also an issue on the objection admission. So last year, our tax laws were changed to define the term admission to be a date when the deposit requirement that I've mentioned earlier on is fulfilled. So after payment of the 1/3, then the objection is considered to have been admitted. But the challenge with that is there are various scenarios where there's still ambiguity. First, in cases where maybe an objection is lodged but the taxpayer is effectively in a tax credit position or a tax loss, so there's actually no tax deposit to be paid, then there's no clarity on what is the deemed admission date in such case. Or in scenarios where a taxpayer has requested for a waiver and they have been granted a full waiver, again, there's no requirement to pay a deposit. But also, I mean, generally in practice, the tax deposit tend to be paid in advance of lodging the objection. So if you read these laws and if you go by the law, effectively what it says is the objection would be deemed to be admitted even before it has been submitted. So a bit of clarity there is required. And to put it in simple terms, the proposal here is for the admission to be deemed to happen on the letter of either the payment of the tax deposit or admission of the objection. The other issue on the tax administration is on the 6 months timeline. So we have a rule that deem determination of assessment after expiry of 6 months from the date of admission, which is the date I was talking about earlier on. Now, the main challenge with this is the assessment is deemed to be determined in favor of the TRA, or basically whatever TRA had issued, the assessment is considered to have been final. Now, the proposal here is for the assessment to be deemed to be in line with objection, and this is in line with what we are seeing in other jurisdictions, and also even in Tanzania, what we are seeing in Zanzibar. I will quickly go through the income taxes, as I know we are running out of time. So the first proposal is on rationalization of taxes for small and medium enterprises. There are a number of proposals, but one of them is to lower the corporate income tax rate. This is to encourage voluntary compliance and also reduce the tax burden to these smaller companies. Another proposal is to abolish the alternative minimum tax. Since currently we have two rules that seek to tax companies in case they're in a loss position. One being the alternative minimum tax, and the other is the 30% applicable in case of tax loss restriction rules. So there is based on the current wording of those rules, there is a risk of depending on interpretation. There is a risk of both rules being applied at the same time. So for consistency and clarity, the proposal is to remove AMT. Another proposal is on the foreign exchange, where we're proposing for the realization. Sorry, the laws here requires for the foreign exchange difference to be deductible on a realization basis once they are realized. The proposal is for this to only be limited on long-term loans, because it's practically difficult to track realization and prove realization has happened for foreign exchanges arising from working capital. There is a proposal on the indexation of costs. This is a provision that was historically there on the old income tax before this current one, but currently we don't have this provision, and effectively what happens is without the indexation, one could easily be deemed to accrue again arising purely from depreciation of the Tanzanian shilling. Another one is an amendment on the single installment tax provision, where currently a company is deemed to have triggered these rules at the area of realization, so at the area of actual transfer, signing of agreement, or payment. So even on signing of transfer of shares or transfer of land, a company's, the tax provision, the tax compliance provisions are considered to kick in. Now, the challenge here is one, entities could sign an agreement and decide to cancel it later on. What are the recourse for that? But also, the entities will effectively be asked to pay taxes while they've just signed a paper and they've not received the corresponding consideration. We have CFC rules which seek to bring to tax subsidiaries of Tanzanian-based companies. There are various proposals here to try to streamline the rules and boost Tanzania as an holding jurisdiction. One of the proposals is to have a white list of countries where the tax rates are effectively the same or higher than Tanzania, including our neighboring countries. Another proposal on the withholding tax, and I touched a bit when I was going through the tax landscape in various countries. is on applicability of withholding tax on resident service providers, where we're proposing for this to be removed because effectively there is no tax leakage. These are resident providers and they will be taxed nonetheless in Tanzania. This is to align with what we have seen in Rwanda as well. On this SDL and WCF, the proposal is first to reduce the rate, as I presented earlier on. The effective taxes on employees or the taxes payable by employers on the higher side as compared to what we are seeing in the region. And also we have duplicity of taxes. So first is to reduce the rate, but also to combine SDL and WCF such that you pay it once and then the government could do their internal allocation across the authorities. For SMEs, the proposal is to exempt them from SDL. One, to encourage formalizations, and also to encourage these small and medium enterprises to employ to employ people, especially new graduates and the like. Lastly, on social security contribution, there's also a proposal to reduce the rate of the social security contribution to 15%, and so as to not have an immediate erosion of the tax of the revenues on the government. The proposal is to spread that reduction across a 5-year time frame. And there's also a proposal to consider putting a cap on the contribution. So if 15%, if the proposed 15% is below a certain amount, then there has to be a cap. I will pause there and invite my colleague Fadhila to take us through the next part. I've seen there's some questions, comments coming through the chat. I think we will address them at the end. Thank you.
Can you hear me now? Am I audible? Yeah. All right. Thank you. Good afternoon, everyone. My name is Fadhila Tisekwa. I'm a senior manager at PwC Tanzania, and I specialize in indirect taxes. So I'll be taking you through the proposals from an indirect tax perspective, specifically with a focus on VAT and excise duty and on the cross-cutting issues. So I'll just turn off my camera for ease of presentation. Yeah. So one of the proposals is to provide clarity on how to determine the place of effective use and enjoyment in the context of zero rating provisions, because the law provides that you can only zero rate exported services when the effective use and enjoyment happens outside Tanzania, but there's no clarification, often leading to disputes between the taxpayers and the revenue authority. Another issue that has been presented is on VAT refund rejections. We are seeing the tax authorities increasingly rejecting VAT refunds based on differing interpretations, particularly for intending traders on the basis that they've not started making any supplies or making taxable supplies, and also see them rejecting VAT refunds applied by international transportation and ancillary services providers, and this is on the basis that subcontractors of these international transportation services would invoice maybe a local subcontractor as opposed to an non-resident. And unfortunately, the revenue authority looks at the invoicing rather than the nature of the supply. So the ask in this VAT refund rejection issues is to either clarify the law or provide clarity, which is based on best practice and VAT principles. Another issue is on how to determine consideration of a supply when a discount or rebate is offered, and more when a contingent rebate or contingent discount situation arises. The law excludes rebates and discounts from the consideration. However, it provides that this should be allowed and accounted for at the time of supply, but it doesn't really provide clear guidance on what this accounting and allowance should look like. So often there will be differing views between the revenue authorities and the taxpayers, and hence a call for this provision to be either clarified or stricken off to in terms of the part that creates ambiguity. Another issue is a call to amend the definition of entertainment. Entertainment is restricted from input tax claim, and therefore the VAT law in Tanzania has a broad definition of entertainment to cover food, beverages, and hospitality. And most time you'll find there's unintended disallowance of business accommodation or food and beverages offered to people who work in remote areas, and therefore causing an undue burden on businesses. So the ask here is to either amend the entertainment definition to bring clarity so that those undue consequences don't arise. Another issue is on VAT deferment scheme. So the scheme applies to both imported capital goods and locally manufactured capital goods. But then our law currently, as it is, will remove this deferment scheme for imported goods from 1st July 2026. While the spirit is commendable that they're trying to boost local manufacturing of these capital goods, but we feel that the move is premature, and therefore to reinstate this scheme for imported goods even beyond 2026. Next slide, please. Yeah. So if we move to excess duty, there's a proposal. We have a very old excess duty act with provisions that are dating as far back as 1954. And now with the advancement in technology, evolving business models, and also expansion of the excess duty act to include services in scope, we feel that the excess duty law is no longer fit for purpose, and therefore the call is to overhaul it entirely in order to modernize it, simplify it, and as well as harmonize it. But in the meantime, since that is a long-term project, the quick wins could be to include provisions that explicitly exclude services supplied to intermediaries from the scope of excess duty, because the way the law is currently drafted, there is a bit of ambiguity in that area, as well as explicitly exclude exported services from the scope of excess duty, again, to bring clarity and certainty in application and administration of the law. And then also there's a call to reduce tax rates from services, example, telcos, which attract 17%, which is the highest in the region, as we could see from Johnson's presentation. We're also calling or proposing that the excess duty tax points be reconsidered, maybe to align to VAT tax points, because we are seeing high excess duty rates, for instance, recently introduced on ENA, which would even be twice the price of the good itself. So, which, since excess duty now is collected on production, that causes a burden on businesses because there's a requirement to pre-finance that duty. So that is basically it for me in terms of the cross-cutting issues. There are other issues which are specific to some industries. For instance, tourism, there's an issue on VAT deposits, VAT on park fees. We have telcos in terms of VAT exemption on smartphones. Agriculture, again, zero rating of research that is exported, etc. I won't delve too much into those, but then those are available in our pre-budget bulletins, which are available on our PwC website. So if you have time, you can also visit those. With that, I'll stop there, and I'll welcome the Kenyan team to present on their proposals. Thank you. Sorry, colleagues from Kenya, if anybody is speaking.
Sorry, can you hear me?
Yeah, I can hear you now. Yes.
Apologies.
Thank you.
Hi, everyone. I'm Edward Paranta, a manager within PwC Kenya's tax practice. With me this afternoon is Musin Maxi, and we'll be taking you through some of the proposed changes by Kenya's Finance Bill 2025. As earlier mentioned by my colleague Johnson, Kenya's finance bill a draft has already been issued. It's currently before Parliament, and it's currently, a parliamentary committee is currently receiving submissions from the public on some of the proposed changes. I'll be taking you through the direct taxes proposed changes. Then my colleague Musin will be taking you through the VAT and excise duty proposed changes. Thank you. Starting off on the income tax, one of the key proposals that we've seen come through is the limitation of tax loss carryover period to 5 years, compared to the existing carryover, which is, currently is indefinite. The impact of this proposal is it's going to affect some of the sectors that are quite capital intensive, such as the energy sector, as well as manufacturing, largely because these are very capital intensive and rely on the capital allowances, which initially does make economic sense if it is factored in or if it is to be recovered as a whole. With the 5 years, there's likelihood that taxpayers will lose the unutilized losses past the 5th year, making the cost a little expensive. The second proposal is removal of investment deduction. Currently, we do have an investment deduction rate, which is a capital allowance of about 100% and 150% for investments exceeding Kenya shilling 1 billion, especially for the investments that are done outside Nairobi City as well as Mombasa County. This provision encourages investments in other counties rather than have concentration of investments in these two municipal cities. With its repeal, it's significantly going to affect some of the sectors, such as energy, where we have some of the geothermal plants which are based outside Nairobi, such as counties such as Nakuru and Naivasha. With this repealed, we're likely to see this leading to a higher cost of power, possibly in a few years down the line in Kenya, as producers are likely to include this and increase the tariff. Another change that did come through from a direct tax perspective is an inclusion of distributor or payments to distributors in the definition of royalty. This aligns with a prior amendment that was introduced by Kenya's Tax Laws Amendment Act 2024, which sought to repeal the initial definition of royalty that was based on various intellectual property rights to more a model that is based on payments, as the tax authority seeks to run away from recent decisions from the Tax Appeals Tribunal as well as the High Court, which made it a little bit impossible for them to recover withholding tax on some of the definitions that were already contained in the Income Tax Act. There's also a removal of the minimum threshold of Kenya shilling 5 million turnover on the trigger of significant economic presence tax. The significant economic presence tax did come into operation in Kenya on 27th December of 2024 through the Tax Laws Amendment Act. This threshold provided reprieve for the businesses that did not have much turnover. However, we see its removal as aimed to harmonize such that significant economic presence tax applies to all. It's going to result into a bit of challenge from an enforcement perspective, but there's a lot to be seen whether Parliament agrees to this proposal to remove this threshold. There's also a reduction in the tax rate of digital asset tax from the current 3% to 1.5%. A key introduction, which we note as a significant win, is the introduction of advanced pricing arrangements. What this does is it does allow for taxpayers to enter into arrangements with the KRA prior to undertaking transactions from a transfer pricing arrangement perspective. This will go a long way in reducing, transfer pricing disputes. And, we hope that this will open the door to more certainty insofar as transfer pricing methods that are adopted by taxpayers, as well as, for big transactions, it's going to go a long way in making sure that the taxpayers avoid huge assessments that we've been seeing in the recent past. Over to the next. Sorry, Rafael, to the next slide. Thanks. On employment taxes, there have been a few proposals. A key one was increasing the tax exempt thresholds for per diems from the current 2,000 per day to Kenya shilling 10,000 per day. This will allow taxpayers to have any taxpayers that do have per diems to have more take home, which is still one of the aims by the government to try and ensure the take home for employed Kenyans does increase, as it's been a significant area of focus of late. Repeal of tax exemption on employment income for certain expatriate employees. There's currently a provision that does allow certain expatriate employee income to be exempt in an aim that is aimed at harmonizing the exemptions. The Finance Bill 2025 has repealed that as well. Tax exemption for gratuity payments from both public and private schemes. This is meant to harmonize such that there's no disparity whether your gratuity payments are coming from public or private schemes. There's also been introduction of a deduction for mortgage interest on funds supplied on the construction of premises for residential purposes. This is a welcome move as the government steps up its effort to encourage the use of mortgages by Kenyans. There's been a repeal of tax exemptions on pension withdrawals prior to retirement. This is a move that is sort of meant to, discourage the access of pension prior to retirement. Again, and lastly, on the employment taxes is amendment to the tax rate applicable to fringe benefit tax to the corporate tax applicable on the resident employer, still meant to cause a bit of harmonization. So before I move to the next slide, I just want to mention that, broadly from the Finance Bill 2025, some of the common themes we are seeing across is the government is really rationalizing the tax exemptions. There's a clampdown on the tax exemptions. There's an increase in powers that are being granted to the Revenue Authority. We'll see as we come to the enforcement, that is the Tax Procedures Act, that you'll see that there's a move to grant the KRA or the Kenya Revenue Authority significant power in excess of what is currently provided in law. This is, whilst the government says that this year's finance bill is not very far-reaching, some of the key measures that we've seen, such as repeal of the investment deduction, as well as the introduction of limitation of carry forward losses, do have significant impact insofar as various sectors are concerned. On to the next slide, which deals with our tax administration. A key proposal that has been included is the extension of the commissioner's power to determine the refund application process from 90 days to 120 days, and for applications subjected to audit from 120 days to 180 days. This increases the period within which a refund is to be done, from a net total of close to 210 days to a total of 300 days, which is quite long. And most of the taxpayers are going in to say that, we need to relook at this, largely because at the moment, the refund process is a bit, it's a bit strenuous for most taxpayers. There's also been a repeal of a section that limits the commissioner's power, the commissioner's power from issuing agency notices where a taxpayer has lodged an appeal against a decision of the Tax Appeals Tribunal, as well as a court decision. Now, currently the provision that is there is that where you have an appeal against an unfavorable decision of the Tax Appeals Tribunal or from the High Court in Kenya, at a higher court, the KRA or the commissioner is stopped from issuing agency notices against you. The KRA is seeking, or the commissioner is seeking, repeal of this provision, which therefore means in cases where you'd have any ruling that goes against, that goes against you as a taxpayer, they can immediately attach your accounts, which, the challenge with this is it leads to a lot of court cases, as taxpayers will be forced to go to higher courts to seek reprieve in sort of stay orders. So we do not really see it as a solution. Rather, it will amount to a burdening of the process or the legal process, and also it restricts access to justice. There's also been a deletion of the provision that excludes weekends and public holidays from computation of time in lodging objections and appeals. This was a new provision that had previously been introduced, which meant that, weekends and holidays were excluded in the computation of the 60 days, from lodging of objections, while for appeals, the 30 days that was applicable in some cases. There's also one other provision, is an amendment to Section 31 of the Tax Procedures Act, requiring that the commissioner has to provide reasons for amended assessments. This is welcome, largely because it also ensures that as a taxpayer, as you respond to the amended assessment, you do have reasons for it, and are in a good position to give, a solid response that captures, your understanding of where the commissioner is coming from. The other provision is the deletion of limitation, preventing the commissioner from demanding that a taxpayer integrate or share data concerning the trade secrets or personal information. This provision is not new. In the tax laws amendment, bill that was there in December last year, the government tried to introduce this provision. However, there was a significant backlash from taxpayers as they felt that there are some trade sensitive data, some trade sensitive information, which taxpayers felt as though this would be tantamount to an infringement on their right to privacy. This again, to have it in this finance bill is still the carry trying to have this provision in place, which we've seen a lot of proposals going in before the committee in Parliament seeking that this provision be removed. Last but not least is the exclusion of the principal tax from the penalty for failure to withhold tax, where the recipient of the payment has paid and accounted for the full principal tax on the tax not withheld. So what used to happen is where I as the payer of, the obligation to withhold is on the payer of the amount that is subject to withholding tax. Where I did not withhold and the recipient has paid tax on the whole amount, KRA would be having a double bite at the cherry, 2 bites at the cherry, largely because they'd have collected the corporate income tax on the end of the recipient, while on the payer's end, they'll still demand the outstanding taxes as though they were due from the payer of the said tax. On to the last slide on the tax administration. Sorry. All right, I'll invite my colleague Musin to walk you through some of the changes from an indirect tax perspective. Happy to take any questions that you may have at the end of the presentation. Over to you, Musin.
Thank you so much, Paranta. Hi, everyone. My name's Mohsin Makasi. I'm part of the indirect taxes team at PwC Kenya, and I'm stepping in on behalf of my colleague, Michael. So as my colleague Edward has mentioned, the theme, this is one of the calm finance bills that you have seen. And most of the proposals that you have seen that are coming through are more of cleaning up redundant provisions in the law, as well as streamlining the tax administration and rationalizing government expenditure, especially where remitting of refunds from the exchequer is concerned. Yeah, so I delve into the changes and the direct taxes from starting with VAT. One of the changes is there's a proposal to reduce the timeline allowed to lodge VAT refunds that are arising from excess input VAT credits. So the current practice as taxpayers can lodge refunds arising from excess input VAT credits in a period of 24 months from the date of the supply. So now this is moving to, the proposal is to limit this to a period of 12 months. So the proposal is just to impose stringent timelines to taxpayers, and this means they have to be more keen in ensuring that they timely lodge these claims in these new timelines to avoid these excess input VAT to become irrecoverable. The other change is on recoverability of bad debts. The VAT incurred on bad debts. So this is a welcome move because the proposal is to amend the threshold for lodging VAT refunds on bad debts from a period of 3 years to 2 years from the date of the supply. So in essence, this ensures that it provides from a business perspective, it improves the cash flows as well as enhance the refund process. The other change is on an introduction of a new section under the VAT Act, just to mandate payment of VAT where goods that currently have an exemption or zero rating status are disposed or used in a manner that is inconsistent with the intended VAT incentive. So the essence here is just to curb tax leakage as far as these incentivized goods are concerned. Then we also have another change, and this is with respect to the schedules under the VAT Act. So there's been a cleanup and classification of items. So one, we have seen items being moved from zero-rated schedule to exempt schedule. And these are raw materials for manufacturing of pharmaceutical products. We have animal feed products, locally assembled mobile phones, electric buses and bicycles, as well as solar and lithium batteries. So what we're seeing here is that this proposed reclassification will have an impact on the it will inflate the product prices of these items due to non-deductibility of VAT. So too, on the reclassification of items, there's also items being moved from an exempt schedule to zero-rated schedule. And again, this aligns with this year's theme under the finance bill, just for the purpose of ensuring that only essential goods and services are exempted. So the list is not a bit exhaustive, but some of the items that we have captured is the locally assembled motor vehicles for transportation of tourists, as well as inputs used in the manufacture of passenger motor vehicles. Yeah, so those are the main changes under the VAT Act. Moving on to excise duty. Again, this is one of the rare bills that you have seen. There's been not many adjustments in terms of revising the applicable rates, especially on accessible services, but it's more of redefining terms and as well as broadening the tax base for some of the items, which we understand that they have more impact on the business profits rather than to the common mwananchi. So one of the changes is that there's an expansion, redefining the term digital lender. So what we are seeing here is you may be aware there's been a growth in terms of advancements in technology and players in the digital lending space. So some of these are either regulated and some that are not regulated. Even we might find that some business models that are not really tied to services provided to financial institutions. So the government here is trying to bring all of these players under the digital lending space into the tax net. So the proposed definition is just to bring into tax any person extending credit through an electronic medium, including, and that excludes the traditional financial institutions, the likes of banks, SACCOs, and microfinance institutions. So, so the other change is an introduction of a definition of non-resident person and digital, and also definition on digital marketplace. So there was an introduction of excise duty on accessible services provided by non-resident persons to Kenyan recipients. In the Tax Laws Amendment Act that came into effect last December. So this it's just a clarification on what entails a non-resident person and what digital marketplace should entail as far as provision of accessible services via an internet electronic means is concerned. Yeah, and the another change is on an amendment to introduce timelines under which the commissioner can grant a decision, can issue a decision in terms of timelines for application of the excise license. So before this, it was open-ended. Now commissioner has to review the excise license application and issue a decision within 14 days. The only ambiguity I'm seeing here is that still it's not clear what happens when the commissioner fails to issue a decision within 14 days. Yeah, and so the other last change that I'd like to bring to attention is on the imposition of excise duty on spirits, and this is just to ensure they eliminate inequality in the alcoholic beverages sector by ensuring all players are taxed. So it's just imposing excise duty at the rate of 500 Kenya shilling per liter on all highly concentrated alcohol purchased by spirituous beverage manufacturers. Yeah, so basically those are the few changes that we wanted to highlight from an indirect tax perspective. I would welcome our team from Uganda to continue with the presentation. Thank you.
All right, thank you very much, everyone. Good afternoon. My name is James Foveru from Uganda. I'll be taking you through the direct taxes, and then my colleague Julie will take you through the indirect taxes. And to start us off, this year we've not had so many amendments come through in comparison to the previous years. And as you will see, I'll take you through the tax administration first, then the income tax and the stamp duty. So this year, the first amendment that came through sought to expand the definition of tax identification number to allow resident individuals to use their national identification numbers, businesses to use their business registration numbers, and non-residents to use their tax identification numbers issued from other foreign countries as their tax identification numbers in Uganda. So going forward, for example, an individual could just use their national identification number, which is on the national identity card, as opposed to registering for a new TIN, which is the tax identification number. So this is a welcome amendment, as it is expected to ease the burden of tax registration. Then the second amendment is the waiver of interest and penalties outstanding as at 30th June 2024. On the basis that the principal tax is paid before 30th June 2026. So this amendment is similar to previous waivers that we've had in the past 2 years, where government provides incentives for people to become more compliant through declaring unpaid tax and then waiving the interest and penalties on that tax. So the other one, in terms of tax administration, is relates to people or to persons who are granted tax exemptions. They will be required to maintain the conditions and requirements under which those tax exemptions were granted to them for the period of for the exemption period, or else they will be liable to pay the tax that they should have paid had they not been exempt. So this is intended to curb tax exemption abuse, where people get exemptions, and then as soon as the certificate is issued to them, then they do not they do not function in line with the conditions and requirements against which the exemption was given to them. So moving forward, if you're found not to comply with those requirements, then you would be liable to pay the tax that you should have paid had you not been granted the exemption. Kindly just move to the next slide. So in the income tax, the first amendment is proposing an exemption of businesses established by citizens after 1st July 2025, where the investment capital does not exceed 500 million UGX. So the exemption will be granted for a period of 3 years. However, there are certain conditions that the citizens must meet, which the first being that they must not have taken advantage of any exemption in the past. And secondly, they must register with the URA, obviously, and file a business information return. So this is a welcome amendment, as it is, we expect a lot of small and medium enterprises to take advantage of it, to be able to gain from that exemption. The second one relates to the definition of reorganization, where it seeks to expand that definition to extend the rollover relief provision to all persons who transfer their assets to other persons other than individuals. So currently, as the law is worded, this provision only applies to companies, resident companies. But with this amendment, then it would be extended beyond companies, trusts, and all other, trust partnerships and all other entities that other than companies. However, its application may still be difficult because the provision to which the rollover relief provision, in which the word reorganization is mentioned before going to the definition of reorganization, still defines reorganization within the context of companies. So we are yet to see how that will play out. But if it is passed as it is, it will be a welcome amendment. The third amendment in the income tax relates to the digital service tax, where they are proposing that digital services provided by non-residents to their associates in Uganda will not be subject to the 5% digital service tax, but rather they will be subject to the standard withholding tax rate, which is 15%, subject to application of a DTA. So as we have it right now, people or non-residents who are taking advantage of the provision that provides for digital service tax to account for a lower withholding tax rate because they are providing digital services to their associates. The last amendment under the income tax is just to exempt two organizations, that's the International Atomic Energy Agency and the Bujagali Hydropower Project. So they will be exempted from income tax. Then the last amendment coming in from the direct taxes is the stamp duty provision, which seeks to exempt agreements or memorandum of an agreement from stamp duty. So currently, stamp duty is charged at 15,000 Uganda shillings on agreements. But if this is passed into law, then there will be no tax payable on those instruments. So that's it from the direct tax perspective. I welcome my colleague Julie to take us through the indirect taxes.
All right, thank you. Thank you, James. Good afternoon, everyone. My name is Juliet Najinda. I'm a senior tax manager looking after indirect taxes in Uganda. And I'll just quickly run us through the indirect tax changes from a Uganda perspective. But like my colleague James mentioned, this year we are seeing very minimal changes in Uganda, and we are attributing that to the upcoming 2026 election. So we want, probably government is looking at a stable tax regime as we are getting into the election year. So from a VAT perspective, we have a few changes. The first change is around government looking at expanding the scope of activities that can be taken to qualify as someone seeking to obtain an undue tax benefit. And here they are looking at people who import goods in separate consignments, where if those goods had been aggregated, they would have qualified the importer to be registered for VAT. So from a VAT perspective in Uganda, one is required to register for VAT if you have make supplies of up to 150 million Uganda shillings. That's roughly $40,000. So what this amendment is looking at is if you're importing goods worth that much and you fragment them under separate consignments, then you'll be seen as someone who's entering into a scheme, and you'll be forcefully registered for VAT. Then away from that, we are also seeing an amendment to the items that are zero rated for VAT purposes. And here the biggest change is around making the supply of leased aircraft zero rated. Currently, these have been exempted from VAT, but now they are moving to being a zero rated supply, which means that companies dealing in such supplies can now fully claim the VAT and seek for refunds of input VAT available. Then we're also seeing some amendments to the exemption schedule. And here we have an inclusion of solar lanterns and biomass pellets. And these are really to encourage, with the climate change to promote the way we are using the environment. But also we are seeing a repeal of the existing VAT exemption on billets. And this is for people who are dealing in those, they'll now be required to pay VAT at a standard rate. Then we are also seeing a widening of the entities that are listed as special public international organizations that operate under a special VAT regime. And here we have the inclusion of United Nations related agencies, which means that such agencies will now be entitled to incentives such as expedited VAT refunds, as well as exemptions for VAT on imported services, among others. So we can move on to the next slide. Then from an excise duty perspective, again, we're seeing a few changes. One of the biggest changes being around introduction of increase of excise duty on cigarettes. This excise duty on cigarettes has been stable for a while, but now government is proposing to increase it, and especially for the imported cigarettes, we are seeing the proposal to double the excise duty rates for both the soft cap and the hinge lid cigarettes for imported cigarettes, and to increase by about 10,000 Uganda shillings for the locally manufactured cigarettes. And this is one of the incentives that government is putting in place to encourage local production of cigarettes. Then we're also seeing a restriction of the excise duty on bags used for carriage of items. Currently in Uganda, excise duty applies on all plastics and plastic products. But now, in order to take away the unfairness that law had provided to people who use, say, things like plastic basins, plastic cups, they are now restricting excise duty to bags and polymers that are typically used for conveyance, with exception of those that are for essential items like juices and those for sanitary pads. And then we're also seeing a proposal to increase excise duty on beer from that is made from local raw materials. The proposal is to increase this by 250 shillings from the current rate of 650 to 900 shillings. And then in an interesting turn of events, we had seen the excise duty bill introduce a proposal to increase excise duty on fuel, both for petrol and diesel. But this was recalled by the Minister of Finance before the bill was even debated by Parliament. So which means that we do not expect this to be brought up in the acts that we are waiting for the President was sent to. Then the final proposal in the excise duty bill is introduction of a mechanism for remission of excise duty paid. What has been happening is that people who are dealing in excisable goods were entitled to refunds of excise duty whenever their goods got damaged, but it wasn't exactly stipulated in the laws. It was something that was happening in practice, but now it has been it's being introduced in the Excise Duty Act, so that then there's clear legislation that provides guidance on how such excise duty remission can be obtained in case of loss or damage of stock. We can move on to the next slide. Then the final one for Uganda is the External Trade Amendment Bill. And here we are seeing mainly two interesting proposals. The first one being an introduction of an import declaration levy. And this is at 1%. This is a new levy. We didn't have it in Uganda. And then in addition to that, we have the infrastructure levy of 1.5% that was already existing. Its scope is now being expanded to cover all goods cleared for home use. Currently, the way the infrastructure levy was working is that it would only apply to goods on which import duty applies, and it would not apply to raw materials and any good whose import duty rate is 0%. But now the only exclusions from import duty declaration and infrastructure levy will be in respect to equipment, plant and machinery, and chapters 84 and 85 of the Common External Tariff Handbook, as well as goods that are imported for special projects by government. And then we also have an introduction of an export levy on wheat bran, cotton cake, and maize bran consigned out of Uganda. And this is really just to drive revenue growth for the government. So that is it for Uganda. I will pause there and welcome my colleague from Rwanda to take us through the changes.
Yes, thank you, Juliet, and good afternoon, everyone. My name is Lukundo Manasseh. I'm a senior tax consultant currently working with PwC in Rwanda. Just to start, there's quite of a difference between the tax law amendment procedure in Rwanda vis-a-vis what happens in the other East African states, because for the other East African states, there's normally the annual Finance Act changes, which kind of impact the rest of the tax laws. But in Rwanda, it's quite different, whereas the government kind of amends various laws throughout the year, depending on when the need might arise, and not through a specific Finance Act, which kind of amends all the various tax laws. And currently, in the beginning of 2025, the government actually issued or announced significant tax reforms, which actually date all the way to 2030, which will cover amendments of different tax laws during that time span, which is quite a medium term amendment in terms of the tax laws in Rwanda. But in this particular presentation, we will cover the proposed bills for 3 laws, which have currently been passed by the parliament, awaiting presidential approval, which are the income tax law, value-added tax law, as well as the excise duty law. I'll welcome my colleague, Chelsea. She'll take us through the objectives for which the government announced these tax reforms, and then we'll cover the specific tax reforms.
Yeah. Thank you, Lukundo, for... Hello. Good afternoon, everyone. Thank you, Lukundo, for that brief introduction. My name is Chelsea Aminga. I'm going to take you through the objectives. I was trying to turn on my video. Okay. All right. All right, so the government proposed through the proposed tax reform, the main objective behind that is strategic alignment, whereby the government aims to support the national strategy for transformation by strengthening its local revenue mobilization and collection, which will reduce the heavy reliance on external financing and enhance more reliance on its own resources. The government looks to achieve this by broadening the tax base, meaning reducing unnecessary exemptions and introducing new taxes where appropriate, so that more sectors contribute fairly to national development. Additionally, the government aims to align the Rwanda's tax system with regional standards to enhance fairness and boost competitiveness across the region, which will ensure local businesses can thrive within the ESC market. Lastly, the government, through the policy measures proposed, also aim to promote public health and social well-being by taxing products and activities that are harmful to our communities. We'll see this through the next slides. Kindly move to the next slides. Okay, so we'll delve into the various key measures proposed by the government and their rationale. The first key tax is capital gains tax. The government has increased, in the draft bill, there's a proposal of the rate has increased from 5% to 10% on the gain on sale or transfer of shares. Previously, this was at 5%, but in the draft bill that has been passed recently, the rate has doubled. So we can see this even in the neighboring countries, as you've seen above. Kenya, it's much higher at 15%. Tanzania and Uganda, the rate is at 30%. Additionally, the scope has been expanded to include a broader taxable class of assets, such as debt instruments, licenses, options, and guarantees. These will close the previous loopholes and ensure more comprehensive taxation. And also, the obligation has been widened to include the buyer and shareholder as well. Originally, the obligation was just sitting on the company whose shares are being sold or transferred. But in the new draft bill, we see that this obligation has been, the obligation scope has been widened to include both the buyer and shareholder. Yeah, so that's from the FGT perspective. We'll speak to the government gambling sector. On the gambling sector, we see the exemption on CAT. Initially, there was a tax on profits, gaming profits at the rate of 28%. However, in the draft bill, the CAT on the profits will no longer apply, and a gaming tax instead has been proposed on the gross gambling revenue, which has increased from 13% to 40%. It was previously there, but just on 13%, while the CAT was taking 28%. So the CAT has been collapsed, and it has been factored into the gross gambling revenue at the rate of 40% in the new bill. So this will only be the 40% will only be the income tax to be paid by the operators, and 28% will no longer apply. Additionally, we see withholding tax on gambling winnings has been increased from 15% to 25%. Well, the government's rationale behind these proposed new changes on gambling is because the intention is to discourage gambling activities in the country generally, but also to ensure that the gambling industry operates in a regulated manner and protects the social welfare of the people. Moving forward to the VAT reforms on ICT equipment, mobile phones, and SIM cards. So previously, there was an exemption on these products with regards to their VAT applicability. However, in the new proposed bill, we see that the exemption has been removed and an introduction of VAT has been imposed on ICT equipment and mobile phones and SIM cards. So initially, the objective for the exemption was to improve affordability and digital access to the people in Rwanda. However, the recent statistics show that the smartphone penetration rate in Rwanda has increased to about 80%, which has led to the policy shift, and the new tax proposed would not only significantly increase the phone prices and discourage their use, it may not significantly increase the phone prices, but it will also encourage many people to own or rather to increase the rate to about 100%, which the government is still encouraging its citizens to adopt so that to accelerate the development, which is crucial for national progress. Yeah, I'll pause here, and my colleague Lukunda will take us through the next reforms.
Yeah, okay. So quickly, I will just take you through the next reforms, which the government has recently introduced the digital service tax, and I think Rwanda has been a latecomer to this party because most of the East African countries have already introduced some form of a digital service tax, particularly to non-resident digital service providers. And the proposed bill currently puts this at a rate of 1.5% of the revenue that these non-residents source from Rwanda. And unlike in other countries, the law only covers Income Tax Act. Nothing on the value-added tax side has been included when it comes to digital service tax. Another reform is particularly on transport and mobility, particularly for hybrid vehicles which run both on electricity as well as gasoline or petroleum. And the government noted a trend in which most of the cars which were being imported were quite old, meaning that they would run significantly on the gasoline or the petroleum part rather than on the hybrid electrical part. And this was counterproductive to the intention of the government, which was to encourage importation of hybrid vehicles to conserve the environment. But because of that, the government has decided to move on with eliminating the VAT exemption that was applying on hybrid vehicles, but not just the VAT exemption that was applying on hybrid vehicles. The current proposals also intend to impose an excise duty on the hybrid vehicles being imported to Rwanda, and the rate will be 5% for vehicles from 3 years and below, but for the range of 3 to 8 years, the rate will be 10%, and for vehicles of the age about 8 years, the rate will be 15%, just to make sure that people are encouraged to import vehicles which are new, meaning that the incentive for the government to protect the environment will be met rather than the reverse. And on the side of purely electric vehicles, the exemption for VAT will stay for some time until 30th June of 2028, where that exemption will also come to an end. And the rationale is the same, whereby people have been abusing this by importing significantly old vehicles, making Rwanda some form of a dumping site for these vehicles, which is counterproductive to the aim that the government had to protect the environment in the first place. The last reform that has been proposed is in terms of excise duty. Raphael, you can go to the next slide. In excise duty, and it's actually in two categories. One is excise duty, particularly in airtime. The current rate is 10%, but the government is proposing to increase this to 12, 14, and then 15% within the next span of the next 3 years. And the aim of this is particularly to harmonize it with the rates in the other East African countries, where we have some at 15, some at 17, and the government aims to harmonize it as well as increase the tax base from the Rwandan side. And the last one is particularly in the recent increases in the excise duty rates on various consumer products. We have natural juice, for which the rate has been increased from 5% to 10%. For beer, particularly locally sourced beers, the rate has been increased from 30 to 40%. And for other beers, meaning whose local raw material content is below that 70%, the excise duty rate is from 60% to 65%. And for wines, the excise duty rate is 30 to the new 40%, which is currently being proposed. And on the side of cigarettes, the specific excise duty rate is 130 Rwandan francs currently, but the government proposes to increase it to 230%. Though the ad valorem rate of 36%, of course, will stay, but significantly, all of these measures are particularly intended to increase the tax base in Rwanda, as well as harmonization with what is happening with the rest of the East African countries. And basically, that's all for Rwanda. Raphael, I think you can proceed.
Hi, Frank. So this marks the end of the presentation from the PwC side. We'll just send it over back to you to take us through the Q&A and any next steps. Thank you.
Thank you, Johnson, and the team for the detailed presentations. I think the participants will appreciate the different tax proposals, but also the different measures that partner states are taking with regards to domestic taxes and other taxes. So we open the floor for questions. In case you have any questions, kindly raise your hand, and my colleague here, Patrick, is going to give you the mic so that you can ask the question. So we keep the questions very short. I think we have about half an hour for Q&A, and we'll have to conclude our webinar for today. But in the meantime, also, if you fail to use the microphone, you can type your questions. So maybe Johnson and your team, you can also look at some of the charts that are already there. People were wondering about SMEs and some other SEZ regulations. I don't know if these were pertaining to some of the early presentations for Tanzania and Kenya, but you can just look at them and see if you can respond.
Thanks, Frank. So maybe I'll start with the question from Emma, where she asks what qualifies a company to be an SME. I think this refers to the part of the presentation we talked about the rationalization of taxes for SMEs. So Emma, in Tanzania, we currently don't have special rules for SMEs. That's what we're currently proposing on. But the expectation is if that proposal goes through and special rules are introduced, then definitely there will be set criteria on what qualifies as SMEs. The only thing probably I would say, which is currently there in the laws that somehow can cover them, but it's not necessarily intended for that and it would not cover all the SMEs, is the threshold that we have on the VAT for the filing requirement. But yeah, I mean, we're all waiting to see when those rules come in. I think there will be a set criteria, as we have seen in other countries where there are specific rules for SMEs. We'll probably skip the question from Frank. We'll come back to that. There's a question for PwC Kenya. Maybe my colleagues from Kenya can unmute and respond to the question from Betty. I'm trying to go in the chronological order. Thanks.
Thanks, Johnson. Maybe I can respond to that question. And maybe for the just for background and context, the way I see the question asks to comment on the withholding VAT set of restriction under the Finance Bill 2025. So maybe for context, is that the way the withholding VAT regime in Kenya works is that where a taxpayer is appointed by the Kenya Revenue Authority to act as a withholding VAT agent, they're supposed to withhold 2% of the taxable value and remit the same to the Kenya Revenue Authority within 5 working days after making payment. Yeah, so what the law provides is that where this amount is withheld, it becomes as a credit to the supplier upon filing their next VAT return. So there are 2 avenues that are provided. One is either you can offset this liability, you can offset the withholding VAT credits to any outstanding output VAT liability in your return. And 2, where you have no any output VAT liability to offset, then the same you can apply for a refund within a period of 24 months as the way the law stands right now, and it's about to be changed to move to 12 months. So the proposal here is to change, to limit the access of these credits only by way of an application of refunds and not no longer being able to offset them against any output VAT liability that is available on the return. So in our view, this is one of the adverse changes that have been brought under the finance bill, and we are also trying, as the public participations are still ongoing, we are proposing for that particular provision to be retained, as it will create some cash flow challenges to the taxpayers who have excess withholding VAT liability, excess credits that they need to offset against available output VAT liability, and rather than going all the way to seek for a refund, which it might take some time, as we know, these refunds may be subjected to an audit, so it might create some cash flow challenges to businesses. Yeah, so that is our view for that particular change. And then I would say for the other one, I see there's a comment on the commissioner issuing an excise license within 14 days upon application. So what happens when he doesn't? So based on the provisions, the proposal that came through, it is not clear as it stands on how or what will happen, or rather whether there's any penalty that will be liable to the commissioner with that regard. So it has only provided clarity that the commissioner has to issue a decision on whether they're granting a license within 14 days. Again, it's one of the proposals we have putting forward to the National Treasury, as the stakeholder engagements are still ongoing, to have that clarification on the law to avoid future ambiguities. Yeah, so thank you. That's it from Kenya.
Thank you. Thank you very much. I think there's a hand from A to Z. Maybe you can unmute and ask your question. Okay, while we are waiting for the colleague from A to Z, I had a question regarding recent news I saw in the media that Kenya sought to waive some of the excise duties on some of the agricultural products that were being traded among partner states. This has been one of the challenges that we faced when we engaged our stakeholders who are cross-border traders. So I wanted to confirm with the team from PwC if this has been noticed or noted in the different proposed recommendations this year, and if we can expect it maybe to pass into law in the coming financial year.
Do you want to take that?
Thanks, Johnson. Maybe from a Kenyan perspective, we have not seen such proposals under the finance bill 2025. Maybe it's something that can come later, but again, from a Kenyan perspective, they're trying not to, impose any harsh provisions with regards to trying to calm the situation and just streamline the tax administration that way. Yeah. Maybe perhaps we can get views from other jurisdictions as well.
Okay, thank you very much for that. So maybe we allow the colleague from A to Z to ask the question.
Thank you very much, moderator. Good evening, everyone. My name is Sylvester Kazi. I'm calling from A to Z Group Limited, formerly known as A to Z Textile Mills Limited. And I really appreciate and commend the presenters for the great job which actually PwC has done. And my appreciation also to EABC for bringing us together for this platform. I have just a few questions. One is that we are holding this forum now while budget readings for our regional governments is just at the corner. So I was just wondering, these proposals and any other inputs to be obtained from this meeting will be able to get a chance to the prepared budget by the ministers of finance, which is going to be read soon. And yeah, that one. But for Tanzania side, I think this is going to DAFA. DAFA, you explained about the excise duty harmonization, but I didn't hear anything about harmonization of import duties, whereby sometimes we get challenges. If we have CET, import duty as agreed by the regional players, but in some way you find that there is a chance for government or a particular specific government, for example, Tanzania, to apply what they call stay of application. For example, the regional or the partner states agree that on this particular product, import duty will be 10%. But there is a room for a government to not to apply the agreed rate and go for the external, a stay of application like 20 or 25 or 30% for the same product. This kind of practice actually denies the players in the particular country to be competitive in the same market where we're selling the same, or we are doing the same business. So I was expecting to hear something about this, but unfortunately, it hasn't come up. But it is really something very challenging, especially for the manufacturers, when you have a raw material imported, and it has a different import duty within the partner states. That's one. Two, during importation also, like for example, of raw materials or spares, you find that this practice of value uplifting has been going on from time to time. I'm wondering when should this stop? And once a declaration or an assessment has been done, then the client or the importer should pay what has been assessed or declared. But there is a room for customs officials to uplift the values, and this becomes really a big problem for the for us manufacturers when we're importing raw materials or parts. Yeah, I would like actually to commend Rwanda for their 6-year comprehensive tax reform. Really, this is something very good for any investor would like to see something like that. Predictability of our policies. Such a policy will actually encourage any investor to say, okay, for this, there is this, I'm going to get this, I'm going to enjoy this, or I'm going to, But when, for example, right now, most of us, we are like waiting for a surprise when the budget reading is going to happen, and you start hearing some of the new policies, and most of these are short-lived, like 12 months only. So we propose that policies be long-lived, like what we are seeing, what Rwanda is doing, predictable, and it actually encourages investment. Yeah, we have been hearing even ourselves from the private sector encouraging our other private sector to invest in our countries. But when you have policies which are not attractive or not predictable, it actually doesn't work well to attract investment. That's all I have for now. Thank you very much.
Thank you very much, Mr. Kazi, for those insightful comments. So maybe for the response, our acting AD, Mr. Adrian would like to provide some clarity on some of the questions you have raised. Karibu, Mr. Njau.
Okay, thank you very much, Mr. Dafa and Mr. Kaz for the question regarding the import duty, especially on the application of the common external tariff. And I think his question is asking why we didn't discuss the import duty as well as the issue of stay application. This is because, for example, the issue of import duty, actually you will not see the proposal until the budget comes. Once the budget is coming, then we will have a post-budget webinar where we are going to discuss some of those changing of the common external tariff through stay of application and the country-specific remission. This webinar was specifically focusing on domestic taxes, where we are focusing, we are looking those proposals, and are we harmonizing our domestic taxes, or we are increasing the disparity? That is what we are looking in terms of looking those proposal. And regarding the stay of application, actually, it has been realized it is a problem in this region because according to ESC Secretariat analysis for the last 2 financial years, they have found, for example, stay application account about 30% of the common external tariff. So you find those tariff line, we are not applying uniformly. For stay of application is about 30%. So you can find it is only even less than 70%, which we are uniformly applying, because also there is a country-specific duty remission, where each country apply a different duty remission. And when you look, for example, country-specific duty remission, which now they are actually accounting 11% of the EAC-CT. And you find that when you look at the loss of revenue, the loss of tax because of this specific duty remission is around USD 63.4 billion. So there is a big challenge on this particular area, and I think we'll discuss it after the budget through the post-budget webinar, which will come later in July and August, after realizing what each country actually apply in their budget. Back to you. Also, you talk about evaluation, different evaluation. And I think this is a challenge because the evaluation is conducted at national level with the revenue authorities, but actually there is a clear modality on how to value the imported product based on the ESC Custom Management Act. And maybe the challenge is when it's come to interpretation of those acts, they are done or they're implemented by at national level. And each revenue authorities actually using those methods, you find they differ. That's why you find when you import maybe certain product from, when EAC imported a similar product from rest of the world, the value of the tax vary from one country to another, although you find the rate of import duty is the same. So that is one of the challenge which we need to address at EAC level. Thank you very much.
Thank you very much, Mr. Njau, for those comments. And I think also there was a question on the chat from Frank Ford regarding the harmonization of the agreed minimum excise duty rate for alcoholic beverages. So as we are currently aware, the rates have not yet been applied at EAC. So maybe we'll make further follow-up on this and we'll provide the appropriate response. Because this question was if the rate has begun to be applied at the EAC level. So maybe PwC, if you have any reflections or if we have any other questions from participants.
Maybe I'll just open it up to my colleagues in case there are any questions, comments, or reflections.
Hello, sorry, come again, please.
No, I was just, I was writing comments from my previous colleague. So Frank, I see there are no comments from our end. So I just wanted to over back to you. Thank you. And maybe just my sincere thanks to all the attendees for your time and for this very engaging Q&A session. Thanks very much. And as I'm handing over to Frank, I'll just say have a great evening, everyone. Thank you.
Thank you very much, Johnson. And also on our part, I'll give the final remarks to our ED, but I would like to thank everyone for participating. but also take the opportunity to urge all the participants that we will share the presentations and the brief report from this meeting for their reference, and also urge them to visit some of our most recent information that we have posted on social media and website. Particularly, we are organizing the East Africa Business and Investment Summit that is coming up in October. So we urge all our members and all the participants in this meeting to look at our different communications and to also participate. So, Mr. Njau, you are welcome for the final remarks.
Okay, thank you very much, Frank. Let me take this opportunity to thank all for participation in this webinar, but also I thank PwC for very insightful presentation. And I would like to urge the private sector who were in this webinar actually to look on those proposals which were submitted, and where they think maybe the proposal they are not in line with creating conducive environment. I think they still have some time to advocate for the change of those particular proposals. So our webinar was like to give them the insight on the issues which they think maybe they can change. I also actually very supportive of instead of the ESC partner state changing their tax every year, they can actually emulate what the Rwanda is doing, where you come up with some sort of the roadmap or the strategy where for example, you are saying we are giving this incentive or this type of tax, which maybe will last for 5 years. And this creates a lot of predictability, and it can track the investment in particular sector rather than changing every year. And this become uncertainty because the private sector or investors, they are not sure if we will renew the same incentive or changes we have done. So I urge all to stay alert because after the budget, we'll do some sort of analysis to look the tax change which have been effected in those particular partner state. And in July, end of July or early August, we are going to come up with the post budget, where now we are going to look at the actual changes and their implication to business. With those remarks, I thank you, and I can say our webinar is officially closed. Thank you very much.
Asante sana, Mr. Njau. Have a great day, evening, everyone.
Thank you.
Thank you. Thank you.
Thank you.
Asante sana Dafa.